Welcome to the Daily Insights That Matter. We begin today's DITM by talking about the rise in India's foreign exchange reserves. Now, after 2 weeks of continuous fall, the Forex reserves for the week ended 28 October 2022 saw the biggest weekly jump since September 2021, which was aided by the rise in foreign currency assets and the gold reserves. Let's look at the significance of the rise in the foreign currency reserves. Now, the foreign exchange reserves or the Forex reserves are the foreign assets held and controlled by the RBI. The reserves can be in the form of gold or a specific foreign currency or in the form of marketable securities denominated in foreign currencies like T-bills, government bonds, corporate bonds and equities. The foreign reserves are held to maintain liquidity in case of an economic crisis and to ensure that a country meets its foreign obligations and liabilities. Now, India's Forex reserves jumped by $6.56 billion to $531 billion in the week ending October 28, 2022, making it the biggest weekly gain in more than a year. Now, all the indicators in the reserves had witnessed an upside with foreign currency assets outperforming the rest. Now, this comes at a time when the Forex reserves have declined for 11 weeks out of the last 13 weeks and have depreciated by around 16% in this year so far on the back of RBI's intervention in the currency markets and the changes in valuations due to the US dollar strengthening to over 2-decade highs. Now, the spike in the Forex reserves can be attributed to the number of reasons as follows. The first is the rise in the value of the foreign currency assets by $5.77 billion. Now, the foreign currency assets form the largest component of the country's Forex reserves. Foreign currency assets, which are expressed in dollar terms, consist of the effect of appreciation or the depreciation of the non-US currencies like the euro, the pound, the yen, held in foreign exchange reserves. The second is the rise in the gold reserves by $556 million. Third is the valuation gains arising out of the depreciation of the US dollars. And the fourth is the FPI inflows of nearly 8,430 crores in the month of October alone. Now, the rise in reserves will boost investor confidence and will provide some comfort to the government and the RBI in managing India's external and internal financial positions, which will in turn have a positive impact on the economy. Now, it's no secret that the RBI has been selling dollars from its reserves to ensure that there is no sharp decline or depreciation in the value of the rupee. Now, given the volatile global backdrop, there will be fluctuations in the foreign exchange reserves. The RBI will continue to use reserves to manage exchange rate volatility. This will probably erode the reserves buffers further in the near term. That said, India's robust Forex reserves have continued to remain strong despite uncertainty in the global markets, and this will help in limiting external risks to the economy going forward. Now, the capex push plays a vital role in the growth of the Indian economy to move to a higher and sustained economic development trajectory. India's post-pandemic economic recovery was guided by public investment, but the private investment somewhere lacked. Now, the demand for bank loans has increased, driven by the infrastructure, transportation, renewable energy and oil sectors, which have seen a noticeable turnaround in new capital investment by the businesses. Now, the credit to the industry rose by 12.6% in September compared to 1.7% growth a year earlier, growing at the fastest pace it has grown in the last 100 months. Now, credit to large industry grew by 7.9% against a contraction of 2.1% in September last year. Now, in the past few quarters, loan demand was led by higher utilization of working capital on the back of rising commodity prices. Fresh capex by large companies will likely drive it forward from Q2 onwards. Now, with the revival in consumer demand, the rise in private capex can be triggers for industry credit growth, and these could turn out to be the key catalysts for the overall credit growth revival to be much stronger too. So, what does all of this news mean for you? The rise in Forex reserves provides a healthy cushion to the RBI in managing the rupee and also the financial position of the economy. This will therefore have an indirect positive impact on you for time being. Now, given that the industry accounts for more than 25% of all non-food credit, the rate of industry growth may end up being a significant factor in the increase in non-food credit overall. Additionally, the increase in corporate borrowing on the back of capex spending will help ease the government's worries about limited private sector capex spending. This will therefore have an indirect positive impact on you as well. While I say this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.